Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. Today, I wanted to talk to you guys about an interesting topic that is around gold. Of course, gold's been doing so well recently, but it's doing so at a time where equity markets are on the rise. And so whilst we all claim that gold is a safe haven at times of market distress, the question mark is, with equity markets rising, gold rising alongside it, is gold a safe haven? And is it the kind of asset that will hold steady when markets do start to turn over? So as I said, look, when you look historically, we do have this long-term relationship between equity markets and gold. Both of them generally go up, right? And this is great for those looking with a long-term view, because when you're looking to invest, you want something that has a track record of performing well over a long period of time. Both assets have exactly that character trait. And so interestingly enough, when we're talking about gold as being a haven, you would think that a haven should mean that it is the kind of thing that does well when equity markets or risk assets do poorly. But the inverse isn't necessarily true. It's not to say when equity markets do well, then gold doesn't perform, because gold clearly does perform at times that we see equity markets rise. That's exactly what we have been seeing of late. Record highs in play on a regular basis for gold as we see equity markets rise. Now, that's one side of the coin. So gold can rise when equity markets rise, but does gold rise when equity markets fall? Does it mean that it's going to be that haven for you when markets roll over? Of course, there's question marks at the moment around valuations in the US market. There's question marks around how long the Mag 7 names can essentially prop up the wider market, and whether at some point when we see the Mag 7 trade roll over, whether that could cause a collapse in terms of equity markets. And of course, when that happens, people will want to find an asset or asset class for them to invest into and hunker down. Now, also bearing in mind, when we're talking about diversification, you also want assets that are going to do well in different market conditions. It's all well having things that perform very well when equity markets are rising and risk assets are rising. But what about when that starts to turn? Do you have that within your portfolio to be able to perform well during those difficult times? Now, the next slide I wanted to show you was the relationship, the correlation between the likes of the S&P 500 and gold. And what this means is when this correlation is in positive territory, so above the middle line, both of them rise together and fall together. So that's a positive correlation if both of them are moving in the same direction. When it's below that middle line, it means they have a negative correlation. It means that when one goes up, the other one goes down, and vice versa. This highlights the fact that that relationship changes over time. It's not constant. So when we're talking about, equity markets are rolling over and therefore it means gold will rise, or equity markets are rising, therefore it means that gold is likely to fall, that's not necessarily always going to play out exactly like that. The correlation does change over time, and in part, we're going to get into the nuts and bolts of exactly how it can perform during periods of market distress, and highlights exactly how gold can be an asset to hold as a haven, but doesn't necessarily always work perfectly during all phases of that market weakness. Now, this is a sort of long-term view from 1990 to 2025 in terms of the average returns during periods of drawdowns. Now, notably, the drawdown generally sees weakness in equity markets. So you can see that on the left. And in actual fact, what's notable here is that we don't necessarily always see major outperformance for gold. So you can see that on the right-hand side here. In actual fact, gold is in negative territory. So what does this tell us? It means that gold doesn't always perform really well during periods of market distress. In actual fact, it can perform negatively during market distress, but it does essentially sort of provide a haven in the aspect of, if you're seeing 30+% decline elsewhere, but you're seeing a minimal decline in gold, then it's essentially saving you from the worst case scenario and the worst outcomes. but not necessarily giving you major positive returns during that period. This is a different way of narrowing down on that data. We've got a number of different major declines. This is from the website Gold Silver. And you can see here that the performance during market crashes, on this occasion, you can see something quite different. And that is that during these crashes, generally, we do see gold outperforming and gaining ground. We do have some periods, you can see here, 1980 to 1982, major decline in terms of gold. And then you see weakness for a couple of other occasions, 2020, 1998. Now, there will be greater sort of granularity into these sort of occasions. There's different ways that these have played out. A lot of the time, it's a case of really narrowing down exactly what the specifics are in terms of how each one of them played out. You have different periods that you can splice up that sort of show you, oh, if you look at the first period of weakness with the equity markets, gold doesn't do well, but maybe it does well after, things like that, right? So this is my attempt to show you exactly how it has played out in the past and show you, as a result, how when these occasions happen again, how you can expect the likes of gold to perform. So here is the S&P 500 with gold overlaid. Gold is, on this occasion, just to make things confusing, gold is the bars or the candles, and we've got the S&P 500 in line format. The S&P 500 rolling over here in 2020 around the pandemic. And at first, we see gold holding up relatively well. But then we see it collapsing alongside equity markets to reach a bottom and trade within, again, that positive correlation with equities. You see from the middle of this chart onwards, essentially they're trading in lockstep near enough. And that means that we have a positive correlation. Higher prices for equity markets means higher prices for gold. Lower prices for equity markets means a pullback in terms of gold. Now, why do we see gold weakening during times of equity market weakness? And this is part of why I wanted to bring this video to you guys today, because I've been through and I've traded through many of these different market pullbacks and often see the same thing happening time and time again. And it's not haven, and it's not gold providing that haven. Instead, what happens is you essentially see a lot of the time markets will correct in the areas that are highly relevant. Let's say the global financial crisis, 2007, 2008, you might see weakness for banking stocks because it's around the financial sector. And soon enough, that starts to spread. And you see other stocks within equities weakening as well. And soon enough, that spreads. And people are liquidating positions across the board. They start to liquidate positions in assets that should be a haven, aka the likes of gold. If you're suddenly getting margin called across a number of your equity positions, you might sell up your gold. So gold as a haven during this initial period of crisis doesn't always perform perfectly. And in actual fact, this occasion for the pandemic, it actually declined throughout the entirety of the market correction and then rose alongside it. That's not always the case. So here's the 2007 global financial crisis, like I alluded to. Now, we've got a number of different pullbacks, corrections, and wider pullbacks for the equity market. So on this occasion, I've got the S&P 500 as the candles here. And so you can see here 3 separate sections that I've highlighted with these sort of pink zones, to show you periods where equity markets weakened, and therefore we can look at the line and see exactly how gold has performed during that. So you can see on the left-hand side of this chart, back in 2007, February going into March, we saw a pullback, a sharp pullback in terms of equity markets. What happened with gold? Gold did exactly the same, and it started to rise alongside equity markets. So similar to that 2020 chart that I've shown you last time around. If we look at the middle section of this image, you can see that essentially what we're looking at here around the sort of July into August period of 2007, we can see that sharp pullback in terms of equity markets. This time around, gold doesn't rise. It doesn't pull back in a meaningful manner, but it does weaken. So it's more sort of consolidation or retracement phase. And then, interestingly enough, the big sell-off, and that took place at the back end of 2007 into 2008. And we can see equity markets really falling in a steep manner. This time around, gold was prepped. And gold really rallied throughout almost the entirety of that. You can see we did see some consolidation during the period where equity markets started to regain ground. But once they sold off, then gold was on the rise once again. So what does this teach us? It teaches us that a lot of the time when you see the first sort of major sell-off, a lot of the time everyone freaks out, right? And so people sell everything across the board, and gold is part of that. But generally, gold will rise alongside that recovery as well. However, that's not always the case. And certainly once you see the first sort of major sell-off occur, sometimes it then people are better positioned for when the next decline happens, and that's when gold really comes into focus as people are sort of positioning accordingly. Now, the third occasion I wanted to show you was the 2000 dot-com bubble. And we can see here that essentially we've got a major decline pretty much across the entirety of this screen here, right? So 2000 on the left, 2003 on the right. And so what we've seen here is that on the left-hand side, as markets rolled over, so did gold. So gold was declining and bottomed out actually in 2001, despite the fact that the S&P 500 topped out in sort of Q3 of 2000. And then we started to see gold prices really picking up in a dramatic manner. You can see if the lows here are sort of around your sort of 800 mark, you can see the highs on the right almost double that, 1500 and above. So we took a bit of time to recalibrate, and then we finally get going, and gold really sort of outperformed. So that rings relatively true to what we saw in 2007, where we saw the initial period where markets were sort of fearful, saw weakness for gold. But later on, once markets got used to the idea of equity markets declines and the need to reallocate towards havens such as gold, that's when gold really started to pick up in a meaningful manner. Now, part of this idea is around the idea that you have an alternative to gold, and it comes in the form of treasuries. And a lot of the time when we're seeing the expectation of significant rate cuts coming into play, that's when people like to jump on the likes of gold. We see the return from the treasury markets weaken, so lower yields, and therefore I've put the 2-year yield overlapped with the likes of gold here. And so we don't necessarily always have a positive or negative correlation in play here. But what I can show you here is that essentially with the green lines, we've got these recessions, and then we have the US 2-year, which closely tracks what's happening in terms of the Fed funds rate or expectations around where interest rates are going in the US. You can see once the green bar happens, invariably markets reacting before we actually see the technical recession. So markets start to roll over. We see the 2-year rolling over, then we see the technical recession happening. So the 2-year generally rolls first. We'll then see the recession, and then we start to see a little bit beyond that, the 2-year will start to bottom out, right? So if we look at those instances where we're expecting to see a recession, we're expecting to see the central banks taking action, and then that happens and we see it fall beyond the recession and then bottoms out, what happens with gold on these occasions? Well, on the left-hand side, we can see that we didn't necessarily see a huge amount of strength. But beyond that, ever since, the turn of the century, you can see here that the declines seen in terms of the 2-year alongside the recessions generally do mark either the beginning of a bull run for gold or a continuation of that. So we can see many a time that we've seen it picking up in a really meaningful manner after the event. So market crashes, market corrections don't always call for major outperformance in terms of gold. But part of why we might see outperformance is if it then leads to a reaction from the central bank where they try to prop up the economy and try to essentially lift the economy, lift the markets. But that expression comes in the form of lower interest rates. It might come in terms of quantitative easing, and that by and large pushes people away from fiat assets, pushes more towards the likes of gold. And that's why gold does particularly well in the aftermath often of these crises. But as we've seen, it's not always the case that market crashes, market corrections mean outperformance and strength in terms of gold. It is a haven, but a lot of the time that haven role kicks in not immediately, not when markets are crashing. And instead, cash is king during market crashes. And instead, you might, if that crash then leads to a shift in terms of the narrative around monetary policy, that's when you can see outperformance coming into play in terms of gold and a next leg of a bull run or a new bull run coming into play as a result of it. I hope this has been useful for you guys. Make sure to like, subscribe, follow for more, and watch out for more educational content like this.